one of the best ways to go about this is just to use a Fibonacci retracement, meaning it's going to tell us where price should go. So we go from this low, and this is going to go all the way up to the peak of 106. And so it's saying that silver should or could, the most, a healthy pullback would be into this range. So that's $62 to $72 an ounce. If it pulls back deeper than that, it starts to do some damage. That is the sweet spot, that if it pulls back into there and starts to stabilize and then starts to move higher, that could be a point you could get back in, because after that, it could go a whole lot higher. And just based on the same move, going up to the high, and this is using Fibonacci extension, and say it pulls all the way down to the 50% mark, now we can carry that forward. So where's the next move after that? As it starts to find support and starts to move higher, you could move in. It should go to 117 and then 151.
Gold has shattered all-time records, soaring past $4,730 per ounce, while silver has staged a legendary triple-digit charge, touching $95.50, nearly tripling in value over the last year. This explosive rally is fueled by a perfect storm: a global flight to safety following President Trump's 10% tariff threats on European allies, and a critical supply deficit that has seen nearly 26% of silver inventories vanish in a single week. Technical analyst Chris Vermeulen warns that while the triple-digit silver milestone feels like a victory, the speed of this move is catching many off guard. He argues that rather than a beginning, we are likely nearing a significant standout high as retail FOMO reaches a fever pitch. In this discussion, Chris uses Fibonacci retracement to identify a sweet spot for a healthy pullback between $62 and $72, noting that any deeper drop could signal structural damage to the chart. He emphasizes protecting capital over chasing the roller coaster, and outlines how he uses leveraged ETF volume as a red flag for market peaks. Could this be the final blow-off before the music stops? Or will silver stabilize to hit its next extension at $151? Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Yeah, I mean, three digits, triple digits for silver seemed pretty crazy, 4 or 5 months ago. And here we are, probably going to blast through the $100 mark for silver. And here's the thing, you made a good comment there. You said, people waited 40 years for silver to finally break through here. And then suddenly it has this in 3 months, it just goes absolutely ballistic and goes straight up and hits those levels. I mean, it took 40 years for it to build a base and work itself out and get here. It's not like, yes, it unfolded very quickly, but overall, the speed that it happened, I think, is going to catch a lot of people off guard. So because in 3 months, people have gone from, I've had 30 and $100 silver forever, and in 3 months it's now worth triple that. It happened so quick. People think now that the silver run and the precious metals move here is just beginning. I actually see it the opposite. I think we're actually going to see a continued blow-off move to the upside in pretty much all metals. But I do believe time-wise, we are very close to a significant standout high. And I mentioned this earlier. Everyone seems to be moving in. Whoever's open to buying precious metals, that's the everyone, is buying it now. Who have always thought about it and wondered about it, they're now starting to go to the general stores, the retail traders, and buying. Retail individuals are buying it. And so the fact that it's moved so quick, so fast feels great. There's no doubt about it. I'm heavyweight in silver over gold myself. But just because it's happened quick doesn't mean it's the beginning. It doesn't mean silver is going to run for another 10 years. I think it's quite the opposite. And the market usually tops out when people least expect it. Just as everybody gets excited, the music stops, right? It's like fluorescent lights go on, cops pull up, party's over. If you look at the leveraged ETFs on like gold or silver or the inverse ETFs, when they start to spike in volume, it's usually a very, very good signal that commodity is about to put in a major top, because people generally move to the leveraged plays, and a lot of times they do it right, literally 2 or 3 days just before it peaks. So it's not that I use it to trade. It's definitely something that I watch. I'm like, holy crap, here we go. It's like the masses are now putting on, call options. They're buying leveraged ETFs at massive scale, like huge volume spikes. That is a huge red flag. When everybody's putting leverage in after a ridiculously big rally and prices is gapping higher and running up, you got to be aware. I mean, if you go back and look at this silver chart, if I just go back to this previous one, look at these monthly candles. You get a gap up and then it runs higher. You get another gap up and then it runs higher. We're starting to kind of get that. We're really starting to pick up speed. And I think if we start to get another big blow off phase, it comes down to bubbles are very tough because when something is going parabolic like this, it comes to momentum. You got to look at the short-term charts. You got to look at the volume, the sentiment. As I just mentioned, ways to do that is with the leverage ETFs. You kind of have to be happy with a certain level and say, you know what, this is super frothy. The signs are it's going to put in a top any point. I'm going to start selling and trimming off my position. If you want to wait for a bubble to top, the problem with that is you're going to have to go through one of these. You're going to have to ride down one red bar that gives back probably half or more of your recent gains. And so bubbles, you kind of got to ease out, trim as things keep going higher and higher. Be happy with the profits and be like, I'm protecting my capital. I'm locking in gains. I don't care if people make a bit more than me. I want to protect it. I want to be smart about this. That's how I go about it. I'm not in it for the roller coaster ride. I'm in it to protect my capital, lock it in. If it goes higher without me, I'll buy it back later after it's had a multi-month or multi-year pause, and I'll buy it again later when it's ready for another 100 or 200% rally. So I don't get caught up in missing out. I don't get the FOMO with the markets. I've done it long enough. I've watched enough people blow up their accounts that FOMO doesn't bother me when it comes to precious metals or a penny stock that I love. I just let it do what it's going to do. I can buy it back when it's primed and ready for another leg higher. And if I have to pay a higher price for it later, that's fine. One of the best ways to go about this is just to use a Fibonacci retracement, meaning it's going to tell us on average, the momentum, how the mindset works, the universe works, is going to tell us where price should go. So we could take a couple different levels. This is a fairly significant standout low before it ramped up. So we go from this low, and this is going to go all the way up to the peak of 106. And so it's saying that silver should or could, a healthy pullback would be into this range. So that's $62 to $72 an ounce. If it pulls back deeper than that, it starts to do some damage to the chart, and it actually starts to put in significant overhead resistance. I won't get into that. But long story short, that is the sweet spot that if it pulls back into there and starts to stabilize and then starts to move higher, that could be a point you could get back in, because after that, it could go a whole lot higher. And just based on the same move going up to the high, and this is using Fibonacci extension, and say it pulls all the way down to the 50% mark, now we can carry that forward. So where's the next move after that? As it starts to find support and starts to move higher, you could move in. It should go to 117 and then 151. But you don't have to suffer this, buy here, ride it up, and then watch it crash 20, 30%, and then put in all this time for it to rebuild again. You could just, I think the best thing to do here is to let it see what it does at 106, and if it blows off and reverses. But this is the sweet spot. If we, that's where it should find support if it settles back down into that space.
Chris Vermeulen dives into the technical golden ratio, revealing why he is eyeing a $106 target for silver as early as this week. He explains the psychology of a feeding frenzy, where parabolic moves often lead to sharp, knee-jerk corrections back to the $45 to $60 range. Chris emphasizes the importance of a stable game plan over emotional trading, advising viewers to wait for a new launch pad rather than jumping into a vertical rally. Are you prepared to trim your position when the masses are most bullish? Let's hear directly from Chris Vermeulen.
Let's flip back to silver, because I have a $106 per ounce target on silver, which I think we are going to hit probably from the momentum in place, really, maybe even this week. So if we were to just take a look at this last big consolidation in silver, we take the low, we move up to this standout reversal, this pivot high, and we come back down to this low. It's going to give us our two levels that we always follow, or that I always follow. Those two levels are the 618. That's the 61% extension. It's called the golden ratio, the Fibonacci golden ratio. If you move to that level and price has a little bit of a hiccup, which it has, we almost always go up and see price hit the one level, which is the 100% measured move. And so that is at the 106. So that is what I'm expecting to hit most likely this week, just based on the daily chart and the pattern here. And after that, we could see a couple of things. We could see price go ballistic and actually have a little bit more. I say a little bit more. It could have another big blow off phase. It could go up to 120, 130. Huge green bars. It absolutely gets everybody into like this feeding frenzy, but then it could have a very, very sharp reversal and actually put in a peak right when people think it's just getting going. It could be coming to an end temporarily. But that's what I'm expecting is we're going to probably see gold and silver hit their 100% measured moves very quickly here in the next week or two. And then we could see a big blow off phase. It could go even higher. Silver have a big spike, gold. But if we do get that big spike from those levels, that to me is going to be the trigger like, hey, I might actually be looking to actually sell and trim off some of my physical metals. Because when we get into one of these scenarios, usually we get into a very, very sharp correction. And silver is a pretty scary looking chart in terms of that. What goes straight up, likes to come straight back down for at least half of that move. And so if I clear the chart, we could see silver spike up into the triple digits, and then it could easily come back down into the 60s, 50s, or even the $45 range very quickly. Now, people don't want to hear that. I'm going to take it on the chin for that, but that's what I think is going to happen. And because everybody's going to jump on me for saying, silver's about to put in a big blow off peak and probably have a sharp knee-jerk reaction, that is also a signal that most likely it's going to happen. And that's what we see whenever things get like this. Man, you can't say anything bad about the space or you get torn to shreds. And I know enough about the markets that I know there's going to be a very big peak here at some point. I don't see the final signs just yet. I believe we're very, very close for me to start trimming off and selling some of my metals positions. But for the average trader, as you were just saying, like somebody who's watching it go up and they want to get in right now, honestly, the best thing to do, especially looking at this chart, it doesn't matter if it's silver or not, something that's gone straight up like this, you got to just wait for it to have a pullback or pause. It's got to build a new launch pad. You got to let some of this momentum burn off through sideways time on the chart or through a pullback, and then you could re-attack it. But jumping in here, at 94, sure, you might catch a move up to 130 or 120 if it spikes. But if you're that type of person who got in here with that mindset, you're also not going to sell it when it hits 120. So you're going to ride it down anyway. So it really just comes down to you have to have a game plan. You have to not be trading based on how much am I missing and other people making without me. It's got to be like, how can I navigate this with my position and have a stable mindset of how you're going to attack it.
Chris Vermeulen concludes by reminding us that the ultimate goal isn't catching every penny of a rally, but protecting the capital you've worked years to build. The market music often stops exactly when the party feels most alive, and being a smart investor means having the discipline to walk away while others are still dancing. By ignoring the FOMO and waiting for price to build a sustainable new base, you ensure you're ready for the next 200% move without the emotional scars of a crash. Are you ready to trade with logic instead of luck? Share your thoughts in the comments section below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.